Hey everyone, welcome back to Corporate Decoder, the place where we take a look at what companies are really up to and if they're hiding anything under the corporate jargon. Well, today we're diving into Centuri Holdings Inc. and their latest filing. And let me tell you, this one has some interesting moves that could shake things up for them. Before we get into the nitty-gritty, if you're looking for clear, unvarnished facts about what's happening behind the scenes in the corporate world, you've come to the right place. Make sure you're subscribed, and if you want to chat with us and other corporate sleuths, join our Discord server. The link is below in the description. So, what's the big news with Centuri Holdings Inc.? Well, it looks like on July 9th, 2025, they made some pretty significant changes to their main credit agreement. Think of a credit agreement like a company's big loan contract, and this is like them renegotiating the terms of that loan with their banks. This filing is essentially them telling the world, hey, we've changed the rules of our big borrowing deal, and here's what that means. Now, Centuri Holdings trades on the New York Stock Exchange under the ticker symbol CTRI. That means anyone can buy a piece of this company. The main event here is the 6th Amendment to their second amended and restated credit agreement. What does that mean in plain English? It means they've updated their borrowing contract for the 6th time to make new arrangements for their money. One of the biggest changes is that they've replaced their old term loan facility with a new one worth a massive $800 million. This new loan is set to mature in July 2032. Now, of that $800 million, about $93.6 million is brand new money to pay off some existing debts, and the rest, a whopping $706.4 million, is used to refinance their old term loans. This is like trading in an old car for a new one, not just to get a different make and model, but also to get better loan terms. They've also boosted their revolving credit facility, the money they can borrow as needed, from $400 million up to $450 million. Imagine a credit card limit increasing. That's kind of what this is. And not only did they get more borrowing power, they also got more time to repay it. The revolving credit facility, which was due in August 2026, has now been extended to July 2030. This gives them more flexibility and breathing room. Here's a really good piece of news for Centuri. They've managed to get a better deal on their interest rates. For certain types of loans called sell-file loans, the interest rate margin has gone down by 0.25%. If you have a big loan, even a small decrease in interest can save a company a ton of money over time. Now let's talk about how the company measures its financial health. This is where things get really interesting for us watchers. One key metric is the consolidated total net leverage ratio. Think of this as how much debt the company has compared to how much profit it makes before certain expenses. They've set a limit saying this ratio can't go above 450 to 1.0, meaning for every dollar of profit they can't have more than $4.50 of debt. Currently, for any quarter until September 2026, this is the rule. But here's where it gets tougher. They've also agreed that starting from September 2026, this ratio must not exceed 4.00. This shows they expect to either grow their profits significantly or pay down debt to meet this tighter requirement down the road. Another vital measure is the consolidated interest coverage ratio. This basically tells us if the company is making enough money to comfortably pay the interest on its debts. They need to have their profits before interest, taxes, depreciation, and amortization, also known as EBITDA, be at least 2.5 times their interest expenses. This is a good indicator of how stable their debt situation is. To back up all these loans, Centuri is pledging almost everything. They're saying that their ability to repay these loans is secured by pretty much all their assets and future earnings from their subsidiaries. This means if they can't pay the banks have a claim on a lot of the company's operations. Now, for the actual documents filed with this report, Exhibit 10.1 is the actual amendment document. Think of it as the full legal contract detailing all these changes. We're not going to read the whole thing because it's long and legalistic, but we've broken down the key parts for you. And finally, signing off on this report is Gregory Eisenstark, the Executive Vice President and Chief Financial Officer. This is standard procedure to show who is officially making this announcement on behalf of the company. So what's the big picture here? What does this all mean for Centuri Holdings Inc.? Well, on the surface, they're getting more favorable terms on their debt. They've increased their borrowing capacity, extended repayment timelines, and secured lower interest rates on some loans. This is generally a positive sign, suggesting that lenders are confident enough in Centuri to extend more credit and on better terms. The tightening of their leverage and interest coverage ratios also signals a commitment to financial discipline. They're setting targets to ensure they can manage their debt even as they grow, or perhaps as their business environment changes. This forward-looking approach is something investors generally like to see. However, the fact that they are making such significant amendments to their credit agreement suggests they are either undertaking a major project, a significant acquisition, or are preparing for a period of substantial growth that requires more capital. The details of what this $800 million refinancing is for aren't explicitly stated in this particular filing, beyond refinancing existing debt, but typically these kinds of large moves are strategically driven. A key risk to watch is how they manage these increased debt obligations and whether their operational performance can consistently meet the new stricter financial covenants, especially the reduced leverage ratio kicking in after September 2026. If their profits or EBITDA don't grow as expected, meeting these targets could become a challenge. Also, the fact that Southwest Gas Holdings Inc. can now dispose of its ownership in Centuri below 51% without triggering a default under the credit agreement means there's potential for a significant change in ownership or control, which could bring new strategies or uncertainties. Overall, Centuri Holdings seems to be taking steps to strengthen its financial position and secure its future funding. The lower interest rates and increased credit lines are definite wins. The real test will be in their execution and whether their business can grow sufficiently to comfortably handle the debt requirements and any shifts in ownership that might occur. They are playing a long game with these new credit terms, and time will tell if their strategy pays off. Alright, that's our deep dive into Centuri Holdings Inc.'s latest move. What do you think about these financial maneuvers? Are they a sign of strength, or are there unseen risks lurking? Let us know your thoughts in the comments below. If you found this breakdown helpful, give us a thumbs up and subscribe for more corporate decoding goodness. And remember, join our Discord community linked in the description for continued discussions. Thanks for watching, and we'll see you in the next video.